All right, good morning, everybody. So we're here, it's FOMC day. Hopefully we will be done with this sideways week, but I got a feeling that we might not be really. We're gonna very likely have some volatility today. We bounce up and down at FOMC, but then I really expect things to kind of level out again and the market to hold its breath for Japan. The BOJ decision, in my opinion, is something the market is more worried about because the Fed has already told us what they're going to do, right? We already know what the FOMC is. It's going to be a rate hike. At least that's what the Fed said. So the unknown is what is giving the market more concern, right? And the unknown would be Bank of Japan, not FOMC. So it's very likely we're going to end up with a sideways market the whole week. Looking at spot gamma, we got short-term resistance at 45.50 through the 45.65 zone. And we've got short-term support at 4,500. On SPY, 450. There was discussion that if we were to break 4,500, 4480 area is very likely where we would flip and go back up again. So something to consider as well on where our levels are at. We also have crude inventories. Energy's been making some pretty good moves. Yesterday, steel did amazing. Remember that when we get flows in energy, you really want to keep your eye on steel and see if they start making a move. I don't think it's stuck, but it was still a nice move. So that's at 10:30. When I started trading, everybody said energy just didn't have the market cap to move markets to be concerned, right? So don't worry about it. It's just energy. But everything goes in cycles, right? And now energy is large enough to move markets. So what happens in energy very much affects what happens in the broader market. Today, everything's going to be about FOMC. So it really isn't going to have, nothing's going to be more important today on any of these events than the FOMC is going to be. But, generally speaking. We can see the anticipated impact. The only one that really stands out is the FOMC. On Thursday, you can see the ECB is going to do a rate decision. It's the European version of FOMC. And then on Friday, Japan doing the same thing. Right there. So that's the Japanese version of the FOMC. Markets are pretty muted around the world, but it stands out that Hong Kong is one of the positives today, up again 2%. Did I mention the China stimulus, right? It was literally the title yesterday for that for the briefing here. It's not done. We can see it's not done. They're just pumping it up over there. So while the China ADR names really didn't do much yesterday, I think it's just to shake out the weak hands, right? So approach how you will, but this is showing it ain't done yet. 10 o'clock, 10:30, 11:30, and then 2 for the FOMC and 2:30 for POW. Volume is not as light as I would have anticipated. I kind of thought it would be a little more than this, but it makes sense that it's light because everybody's waiting on FOMC. We do have a market maker move, which is implying that a lot of hedging took place this morning in the front end of the curve. So it seems to confuse people that don't trade futures, but this market maker move is on the options for the futures. So if you're just trading, the MS or the MES, you're getting in, you're getting out. That's not the options, right? That's just the contract. The market maker move is on the options of those contracts. It's when you're picking a call or you're picking a put and you're trading it, right? Which is completely different. So they are trading the options of those futures, which is what moves the options average here on the right side. And that's what triggers the market maker move signal. It's when the front series has a higher implied vol average than the next series out. So 1535 is greater than 1475, and that means we have a market maker move, which is as simple as that. But that's the options on the futures, not the futures. We continue to be range bound inside of yesterday's range. I really feel that this is going to be the range until 2 o'clock. But having said that, I wouldn't be surprised if we start to get a little bit of the megaphone again, right? Where we wick outside the bottom and come back in, we wick outside the top and come back in. In the situation like this, what we've been in all week, you want to sell into strength and buy into weakness. Those are the trades that I did yesterday. And sure, if eventually it broke out and ran me over, but until it did, I made more than enough money on the ones that worked. Did the same thing again until it broke out and ran me over. But again, make more money on the ones that did work than on the individual one single trade that didn't. So sell into strength, buy into weakness. It worked even on a day like yesterday where we kept breaking zones and coming up into a new level. It's the very same thing that we want to do today until 2 o'clock. I will say though, if you're losing more often than you win, you probably don't want to trade in a week like this. You want to just avoid it. Stay away from it. Go do something else. Don't even try building strategies in it because this is not the kind of market you want to trade, right? This is trash. We really don't have our classic shape. We're getting a little closer to the D shape, but it's just not there. I think there's something wrong with that EM line. That'll do. So the point of control is back up here at the top with this. When we're at the bottom, we expect to go to the top. When we're at the top, we expect to go to the bottom. We got a minor air pocket. If we were to get below the 45.70 area, it gets a little shallow here. Got a minor support at 45.50. If we break that, there's not much left to catch us, right? 4,500 should be pretty easy. And I'll point out that it's still really shallow for being, you know, the roundy 4,500 big level. There's really not much volume there, which is a surprise. There's way more volume at the cog line 45.11. That's not a surprise that there's a lot of volume here. Even 45.50 is showing a lot of volume, which makes sense, right? It's another one of those big round numbers. It's one of the gamma levels. It's talked about, you know, incessantly on spot gamma and trading ticks and all of the places. So yeah, it makes sense. But where the heck is the volume at 4,500? It continues to just not be there. Like nobody's trading it. They all want to avoid it. It's really odd. Still, our zone is clear. And throughout the day today, unless we do drop all the way down and break below 4,500, the bottom of this profile is going to continue to move higher. Through every new candle we get on the right, we're going to lose one on the left. We're getting really close to turning around here. I'm going to zoom in and just make it tight for a moment. So you can see how we got to revisit this low one more time in the next 4 hours. We're going to lose this low, and slowly that profile is going to start compressing. We really don't have a point of control to bring forward from yesterday, but yesterday we did hit this point of control from last Wednesday. So we're going to take that off the table. We don't need that up there anymore. We do have some below us still, but I don't believe there's anything overhead. All right, the range that I drew earlier in the week still here. It's what we drew on Monday, and when we had that conversation. No, that's not the same box, is it? Did I make it that small? Okay, still the same box. That was our expected range coming into this week. We're still in that range. Nothing has changed. Since we haven't gone anywhere, none of this is going to be any different. We're a little closer to the 10-day, not even 1% away. And we're more than 3.25 above the 10-week. So it's getting closer a little bit at a time. The longer we stay sideways, the closer it's going to get, but it's a slow process, right? Unless we turn and go back towards it, it's going to take a while for that 10 to get up to us because it's a 10-week. There's really not much to go through here on the equity side of things. You're not going to have much of an expectation of equities doing anything on a day like this because they're not going to know if they should continue the rotation or not, right? So, I mean, we can check a couple of things like BABA, Baidu, because we know that China stimulus is still there. We can see it, but look how it gapped up with the algos rebalancing everything, and then it just sold right back down into it again. But as weak as that looks, when we come out onto the daily and the weekly, I mean, this is the weekly chart right here, and that's not bearish. It's really struggling against those highs. No argument about that. But for the rest of it, that's not bearish. My pin is broken. Yeah. Okay, so now it works. So you can see with all these wicks, that they're having a hard time getting through that zone, right? And that every time they come up into that area, there's just a big seller there waiting to unload on them. At some point, that big seller is going to be exhausted. They're not going to have anything left, or they're going to get smart and decide maybe they want to sell it up here somewhere instead. I mean, if you can get more for it, wouldn't you want it? So if we were using OCR, what we continue to see is higher highs, higher lows, and at least yesterday, a higher close. I think that it's just taking a breather and that it's not done yet. Not just in BABA, but in a lot of those China ADRs, right? The moving averages are going to be basically worthless, even if it is a weekly chart. Where our location is with those moving averages is about their only value, right? Are we above the 10 or below it? That has weight behind it. Are we, above the 200 or not? And as you can see, we're above all of them. The 10, the 20, the 50, the 200, we are above all of them. But same thing that we had on BABA, we've got on Baidu. See all those wicks across the top there. Every time we get up into that zone, there's just a large seller there happily getting out of something. Well, they're going to get exhausted. Right? They're going to deplete their pile and not have anything left to sell, or they'll get smart and start selling it at a higher value. Either way, if this continues to, what's the phrase? Persistence beats resistance. So if it continues to press against these highs, it will get through there eventually. It is worth noting, however, when I zoom out, that there's still large sellers. We don't know if they're done yet, right? We have no idea if this is done. And since we didn't get through it and close above it, I would argue that it's not done, that there's probably more sellers there as well. So that's Baidu. PDD, we have a gap that needs to be closed at 91.94. It's a long ways off. Now, some analysts will say, as soon as we get into that candle, that the gap is closed. So they would say 84.73. I'm not that kind of analyst. As far as I'm concerned, we closed up here and we opened down here, and that gap will not be closed until we get back to where we closed at the gap. That's just the way that I do it, right? You can do it either way. Just be consistent in your choice. Don't jump back and forth for whatever suits your needs. Again, with this, it's just like with the other two. We are seeing higher highs and higher lows, right? If we're using OCR analysis, we're above all the major moving averages. And we just have to be concerned with these large sellers, which we don't have as much history here, right? If you think about the other two charts, there were a lot of wicks, a lot of history showing those big sellers. Here, we don't really have that. We just have the big gap down and then one test of that. And now we're driving through it. So I would argue that with PDD, whatever big sellers were there back here, we took them out. There's probably nothing left from those guys. So we should have a pretty good run, at least up into the sellers from here, right? Those wicks are kind of a little bit of a tell, and we just don't know yet. The gap close at 92, just round up for an easy number, would be my target for PDD. That's a pretty simple one. JD. Again, the wicks showing the sellers and wicks showing the sellers again. we have to drive through that zone first. And looking at the pre-market, it's not even trying to do that. JD is not as healthy as the others. It's under the 200, under the 50, but we are starting to get that 2010 cross. And again, I'm on a weekly. So big old gap that needs filled way up here. We're a long ways off from that. And another big gap that needs to be filled down here at 44. I'm just kind of rounding a little bit, but let's put that line in place. 43.27 is a gap that needs. No, nah, let's try that again. That's not a gap. I had the gap marked right there. 43.89. The gap that we're marking is the close here and the open here. This one has already been taken care of, where we closed there and we opened here. We ran up and closed that gap already. We also closed it there. So we would already consider that one done. It's off the table. The one that we need to worry about, 43.89. So this one, JD is less healthy than the other ones that we've been looking at, but it's also more beaten down and has a wider upside opportunity, right? So, one step at a time, we got to get through all these sellers. Then we can target 43.89. If we do continue to fade to the downside, then you might get a chance to maybe buy where these buyers down here were buying. You might get a retest of that. And yeah, there was some buying here, right? That recovery. So that would be $36. Nice little area for a bounce. If this continues, we're going to be building a tighter and tighter wedge. And then, very likely if we zoom out, it's more of that kind of distribution, basing, accumulation, Wyckoff 101 kind of stuff. Makes sense. Right, so I'm kind of looking around, and honestly, we just don't have anything, and it makes perfect sense, right? We shouldn't expect anything today for an opportunity, right? And I know I've had people say, "Oh, you think we're not going to go anywhere? This would be a good day to do a credit spread or an iron condor." It's not. It's not. Oh, well, I'll just do one for the morning, and then I'll close it before the FOMC. Yeah, right. So the argument against that is today, it's very likely that we're going to see the implied volatility continue to rise within the options within the day. So I'll just use yesterday for an example. Suppose, yesterday we were hitting against this high and you thought, well, I'm going to go ahead and put a credit spread there and, get it back at the end of the day. Well, one, you got ran over. So maybe it's not the perfect example, but say you put it on down here, you had a put spread. This should decay as the day goes by because it's a 0 day and it's a put and you're winning and it's moving farther away from you. All of that would be true. And yet I would argue that it's very likely that yesterday, even with price running up, volatility continued to climb and that you were stuck in that credit spread way longer than you wanted to be stuck in it, especially towards this back half of the day when we made that drop. Even just a small move back in the direction of those puts would have probably put that put spread into a negative, and you would have been stuck in it until 3:30, maybe 3:45, much later than you wanted to. And what if it was actually coming back at you? You'd have still been stuck in it, trying to get out of that, when clearly you had a nice winning trade. That's the trickiness of those 0 day options and how fast they can move, especially in the SPX or the S&P. So on today with the FOMC on deck, trying to put on an iron condor, one, you can't get wide enough. Price can still hit you. Two, you're going to get trapped in that iron and you won't get out by lunch like you're wanting to get out, or even by 1 o'clock. You won't be able to get out before the FOMC at a profit that you like. It'll be a negligible profit if you're lucky, if it hadn't already turned negative on you. So just a note of caution on a day like this of thinking that you can put on a morning credit trade and close it before lunch with the expectation that we're not going to go anywhere. The volatility is going to continue to climb and you're going to get stuck in that thing. So let's gauge out some levels of where could we go today, how far, and then we can wrap it up, and we'll use the SPX because it makes sense. The implied volatility suggests that we can move $30 higher or lower, and then the market maker move is 25. So take 20 and 30 is 55, and some change, we'll call it 56. That's 56 higher, 56 lower. That's 112 points total. $56. Just using the EM, the expected move, that is the range for the SPX today. Want to check them and put the spot gamma level in there. Okay, they've got a 0.82% move for today. Oh yeah, they're much shorter than us. They're calling it at around 4,600. So let's just stick with the plan here. This was the expected move range that I got from the options chain. In bouts of volatility, they say you should double this number or double this distance because that's what the options or the market could very easily do. If it says that we could move 50, put in 100. And that's still being very conservative in our number, right? So if you're thinking, oh man, 46.75 today, man, come on, you're tripping. That's a long ways. No, it's not. I'm being very conservative. I'm holding back a lot. If things get out of control today, say the market gets caught off sides, everybody has got the opinion that we're going to see a hike today because that's what the Fed said that we're going to get is a hike today. What if they don't hike? That'll be a shock to the market, catch people off sides. That can move markets. So if we wanted to really consider how bad it could get, we just double that box. And I'm going to leave it kicked off a little bit so we know where the range ends. So how bad could it get today? 4,800? Well, okay, 4,790 and 4,340. That's the range for today. So when you're in there looking at those options and you're thinking, oh yeah, I'll just put my spread right here on the edge because it says we can only move 50 points. Yeah, good luck with that on a day like this. Don't do it, right? It's just not worth it. You can't get far enough away to get safe, right? And if you did, if you did go out and build options at 48.50, there would be so little amount of money in there that it isn't even worth it. It won't cover the commissions you'd spend on the SPX to get the trade on. Remember, those yellow lines is what the EM is for the day. That's it. Everybody be careful, be safe, keep your eye on those numbers 4,500, 4,550, 4,600, right? Those big numbers. I will see you all tomorrow.